All right, all right. Welcome, everybody. Welcome to a very exciting webinar we have today. For those of you who don't know me, my name is George Demoni, and I'm one of the partners here at Plug and Play. Today we have a very exciting webinar and the third in our series of how to raise money in a pandemic. It's truly been exciting and crazy times in the venture world this year, and many startups have taken advantage of it. One of those companies is Hippo, a home insurance platform. Unicorn last year when they raised 100 million at a 1 billion valuation from Mary Meeker's fund, Bond Capital. Hippo just closed an additional $150 million round with premier VCs like Ribbit Capital, making it one of the most valuable private companies in the insurtech space. We are very happy to have backed Hippo early on with an investment and are very excited to have them here today to discuss the tips and tricks how to raise money in this market. And as mentioned, we have two very exciting heavy hitters today. So just a quick round of introductions. Saeed Amidi is the CEO and co-founder of Plug and Play, and he has been investing in technology companies for about 20 years. Plug and Play now has 12 unicorns in the portfolio, which is honestly unheard of for an early stage firm like ours, including Hippo, of course, and others like PayPal, Dropbox, Honey, N26, and many others. He is a serial entrepreneur and a seasoned executive with over 28 years experience in founding, operating, and growing successful companies. He has successfully started and grown businesses both nationally and internationally in countries like Spain, Germany, France, Brazil, Japan, and many more. And then finally, Assaf Wand is the co-founder and CEO of Hippo Insurance, as I mentioned, an insurtech startup based here in Palo Alto. Hippo Insurance provides homeowners with insurance coverage at a rate of 25% less than its competitors. He grew up in Israel and went to the University of Chicago's Booth School of Business for his MBA in finance, and also acquired a law degree in Israel. He is a serial entrepreneur with various successes and an overall amazing guy to be around. I can speak that from personal experience. We were very excited to have him here today. And with that, I'll turn it over to Saeed and Assaf. Guys, take it away.
Thanks. Thank you, George.
Thanks, George.
Thank you, Assaf, for joining us. How is everything in this crazy times? How have you been sheltering in place?
Firstly, great seeing you again, Saeed. Thanks for having me. It's it's an interesting time. At best, it's an interesting time. It's an interesting time to be a founder. It's an interesting time to be a dad. It's an interesting time to be everything. So all of the rules are being rewritten and readjusted. I always have a belief that optimistic people are always looking at it as in the positive. I get to spend more time with the family. I don't travel in as much. It's fine. We'll surpass it, and we're going to be stronger because of it.
That is great. Same as I remember last time we were together, it was like at one of the events at Plug and Play. There was, I would say, at least 500 people there. And we had our insurance advisory board meeting, if you remember. And I don't know when we're going to go back to that sort of gathering again. But it was great seeing you and our friends from Allianz and the other advisors for our insurtech. But Assaf, I'd like to kind of make it more personal and interesting. Can you tell us a little bit about, where you were born? What did you do through school and university before you got to Chicago?
Oh God. Okay, I'll give the short kind of personal version of that. I'm Israeli, as you hear by my crappy accent, which I can't get rid of. Eldest brother in a family of four. My dad was actually in insurance. I used to, drive in the back seat when he used to hand over calendars and things like that, because that was the promotional marketing kind of aspect. But grew up around insurance in a weird way. Then at the age of 18, like every Israeli basically citizen, I went to the military. I served for 5 years in the Israeli military. I was an officer. I finished in the rank of captain. I was part of the Special Air Force Service, so the Special Forces of the Air Force. Traveled the world for a year, like every good Israeli that finished the military. So I went to Southeast Asia and New Zealand and Australia and backpacked for something like 10 months. And came back and started studying law and finance, basically. So I did a dual degree. I was 24 at that time when I started my undergrad, which is a bit on the high side, but not completely different than what our Israelis are doing it. I wanted to live in Tel Aviv, and my parents said, if you want to live in Tel Aviv, then live in Tel Aviv. What do you want from us? You work as a waiter and live in Tel Aviv. Well, you know, it's kind of like you live wherever you want to live. Basically started working as a waiter at the beginning, and then relatively fast started working as a trader in an Israeli basically investment bank, studying in the day and trading at night because of the time difference with the US markets. It was the heydays of the internet bubble, 1998, 1999, and so it was a crazy time, anything, you know, in technology, but even more in trading, because if you think that the market is crazy now, you haven't seen it. It was every random company that latched the .com kind of on their name went public. The time to go public, you had companies, the average time from a company from seed to go public was something like 19 months.
I remember.
There were like 3 funding rounds in that period of time. Half of it was used actually very differently. People were raising $40 million and using $5 million to a launch party. It was an obscene time. It was just, it's very difficult to explain to people that haven't experienced that. But I was making, I don't know, $100 a shift working as a trader and exercising people's options at, you know, $10 million options at that period of time. So I thought that's not a good trade for me. And I left the bank to start an employee stock option kind of trading platform. I'll make this short story even shorter. I sold it to Embrecht and Quest after a year and a half, and then joined Intel Capital as a strategic investment associate. Basically did investment in Israel for 3.5 years. And then I realized I really, really needed a break, and I went to business school.
Wow. Yes, thank you. You know, in fact, I really learned a lot, even though you made your earlier years short. It is incredible that you said you did waitering and trading stock, you know, because, and then after business school, how did you come up with the idea of Hippo? When did you decide that you want to start a business here in US and in InsurTech business?
Oh, even that had several changes. So after business school, I joined McKinsey and Company in New York in the financial institution group. Did several projects with insurance companies. If anybody that works in consulting, that's when you're opening the kimono and you're seeing everything on the inside. And if you thought a company is really, really strong and interesting from the outside, when you open it, basically all companies in the world are broken on the inside. It's just a matter of basically the momentum and the strength of the product and all of that kind of stuff. But it made me a lot more cynical on insurance and gave me a lot of confidence that we can do something. And if anything, I thought that this is an industry I really want to change. It's a massive TAM. I thought a lot of the organizations are not very sophisticated or have all kind of logistical issues and cultural issues, and I love these kind of things. So when I left McKinsey, and I knew I want to start something, I looked at insurance and actually thought it's not a valid option. And there were 3 components. The first one is you couldn't build a backend, because at that point of time, if you wanted to build a backend system, like a policy management system, et cetera, or anything for the company, you would have had to go to like a Guidewire, a Majesco, et cetera. They would have asked you at year 7, how many customers do you think you're going to have? And they're going to start charging you at day 1 for the number, because it's per seat that you need to basically be upfront. it would have taken 4 years to implement, probably would have cost $300 to $400 million. You would have needed to bring in Accenture to basically build it. It was just, that's not a very valid way for an entrepreneur to start a business. Second point was lack of data. When I was looking at it, this was like 2006, 7. All of the cases were, how can you compete with Allstate that has 11 million customers in home, and you have 0, and you don't know anything, and they've been doing it for 100 years, and they've probably ran through 35 million customers at a different point, and you have nothing. So I'm like, okay, I have a massive, basically, discount on the data. And the last component is I couldn't bring myself to a level of conviction that I think people would be willing to buy from a new brand. So to launch a new brand in insurance, which is a game of trust, I had a big doubt that people would be willing to actually go for it. So I basically shelved it and put it on the side.
In 2006, 2007.
Yes. Went back to Israel, co-started 2 telecom companies. We built the largest multi-tenant tower business in India, which is a big business now, 14,000 cell towers. And then also went around the world and bought the 2.5 gig spectrum in emerging markets. We had 17 countries that we bought the spectrum. Côte d'Ivoire, Gabon, I'm trying to think even, do it like so many, Azerbaijan, we bought it in Mozambique, Uganda, and I can give you a list of every bizarro place on earth I've visited, and we bought the spectrum. Did that, companies grew up. One of them, folded in 2008 when we were just closing a really, really big round. In 2008 happened on us. The other one is actually doing very well and going to go public soon. Got married. My wife was by far smarter and better than me, wanted to do her MBA. So we found ourselves in Boston when she went to MIT. And I was like, okay, I need to start something different. I'm going to run through it fast. I started a different business. I started a company that basically catered to baby boomers and built products for them, ran it for 6 years, sold it to a private equity shop, and wasn't ready to retire and be a VC. So I figured I have one more business in me, and I bought from the shelf this insurance thing. I looked at the 3 components that were preventative before, and I figured, okay, building the back end, I can actually do it. I can go on AWS and build something scalable. I can use microservice and use, PayPal or Stripe for payment. I can use Twilio for some components. I can use Intercom for chat. I can do almost everything in a scalable way, in a lot more cost-efficient way. Cloud, which means that I'm going to have significantly less legacy from starting, and I'm not going to be dependent on someone else. Second point is data became an advantage. The way that I look at it, I don't have just 10 million customers. I have data on 130 million households. And I have a lot more data than what they have because they collected data 20 years ago, and they're still using that data. I have the latest and greatest and aerial imagery and permit records and tax records and county records, and the amount of stuff that we get, if anything, we're in a massive advantage. And the last component, we're in a world where you're doing everything online. You're taking your student loans from SoFi, and you're managing your money with Wealthfront, and you're getting a mortgage from Rocket. This is just one more thing. So the hurdle and the bar became a lot lower, and I thought, you know what? It makes sense to start something in insurance. So that was the phase. I want to do something in insurance. That was early 2015, where it wasn't insurtech. Most of the VCs said you can't invest in insurance. It's not a VCable business because it's highly regulated. There's a lot of issues. It's highly regulated. It's a state by state. You need a lot of capital. How can you compete with people that are spending $1.4 billion a year in marketing? It's just not it's not a VCable business, which is interesting because all of these points flipped when it became like insurtech all of a sudden. When we were doing it was hard, and then it became insurtech, and we were at the forefront of it because we basically went through the trenches and got the initial funding to work. And then all of the VCs loved it because, it's really, really hard. The regulation is tough. So you're like on the other side of it, and that's a barrier to entry. But that's basically, that's the at the
Do
beginning.
you know Ishorian, Kevin Twill, and Kamali? You know,
Very well. Yeah, I
they
actually went to pitch it to them.
are you serious that they
Yes.
did this? They actually purchased a small roadside service company and then built the cell phone insurance around it. I didn't know you also purchased something to begin with.
No, no, no. I didn't purchase anything to begin with. We started everything from scratch.
From scratch, yeah.
But you know, but I did talk to Kevin initially for funding.
Mhm.
You know, in Silicon Valley, especially in 2015, if you wanted to do anything in insurance, you would probably find yourself with 4 or 5 people. Tom at Excel was one of them. Kevin was one of them. You know, you can count them on like 3 fingers. The people, and if you were raising money because nobody understood anything, somehow really, really fast you would be routed to these people.
Very good. And tell me about the first round of funding you looked for. I mean, you had a business idea, business plan. Did you already assembled your team? How did you assemble your team? Like, I love to know, like, the first 6 months to a year, how you put everything together.
Sure. So I think one of the biggest thing, at least for me, is that I need to bring myself to the right conviction in order to go and pursue something, as opposed to a VC who needs to bring itself to a conviction, which is never easy, but they're going to write 20 checks. This is the only thing I'm going to do for the next 10 years. So I need to have a very high bar for myself to basically say, this is what I'm, you know, every waking hour, this is what I'm doing. So the bar for myself is significantly higher than the bar for the VCs. So I had to persuade myself that this is something I really want to do. So I sat down and read everything I can read to educate myself. I did the exams to be a broker. I did it on a broad kind of thing. I read so many things. I sat down in the McKinsey office and interviewed every McKinsey partner that did something in insurance and asked him, if you, you know, what are the top 3 problems for a CEO now that you're consulting? And if you would have started something in insurance personally, what you would have started with? And then it was just this kind of the discussion until I started to have a narrative. And then I went and challenged the narrative that I had, which I'll go to in a minute, because it seemed a bit trivial to me. And I wanted to understand why everybody else is not doing it. Only when I brought myself to that conviction, then I felt comfortable enough to go and pursue and find a co-founder. And I was very fortunate to find one of the best technologists probably in the world. My co-founder is a savant in like technology and built all of the systems himself and all of that kind of stuff. And then we felt comfortable enough to go for the fundraising. As I said, it was a very tough fundraising. All of the funds kicked us out because insurance is irrelevant and stuff. We had an interesting discussion, but everybody cut us short because the only reference that they were doing was they went to insurance people who always told them, you know, they wanted to do like a reference or whatever, and everybody shows that that's impossible. You can't really start that. And I'm like, that's exactly why I love that. I also have a massive belief that to really innovate in an industry, you kind of forced to come from the outside. Airbnb would never start from people from the hotel business, and Uber would not start from people from the taxi business. You need to come up with not acknowledging all of the stuff to basically push the barriers and to come up with a new notion. And I told them that that's positive. One of the people that I really liked when I talked to early was a guy called Adam Boyden. Adam used to be the COO of SoFi. And when he saw that, he said, listen, I get it completely. It's SoFi. I get that we have the same kind of thing. He got it at the beginning. And he said, listen, we'll do this round. And then like every round, the second that you have someone who commits, it becomes an oversubscribed. You know, every $2 million round basically have $50 million people waiting for a person to come into this thing. And then they're bitching about that you didn't let them in. But nobody has the balls to actually write the initial check and put a term sheet. And that's what transpires. I think there's a very fine line between a company being shut down because it can't raise money to being an oversubscribed round. And it's just one person who needs to have the balls to write the check and everybody else follows that. So we were fortunate enough to have Adam, who basically on a lot of research that we did and a lot of the de-risking that we were able to do was willing to write us a check. It was a $3.2 million round, which was decent. And we were fortunate enough to have it because one of the problems in InsurTech, especially companies that actually write a product and touch a customer, is there is no MVP. It's not, oh, let's finagle something and start selling it. No, you need regulated. You need, in our case, we needed to change the product. So I need to file in California and get admitted. If you have an admitted product and that takes freaking forever, we also have to have a policy management system and build all of that kind of stuff. We need to have underwriters. We need to have the other stuff as well. We need to have a claim center. The first second that I have one customer, I also need to have a claim center waiting. That's a different system. We need to have a call center. So you need to build a lot of infrastructure before you even have one customer. And most VCs do not understand the de-risking that was actually done to get one customer. So they're like, what are you talking about? You want an A round. You have 135 customers. I'm like, yes.
What date or what was your first customer? Do you remember?
I think 23rd of April, 2017. And it was me. I was the first customer.
Was it strictly online or did you
tell
your neighbor to buy it and go online and process it?
No, it's as manual as you can get. I was the first customer. So it was me. And then while we went online, we did a competition on the first 100 customers. I sold 92 of the 100.
Wow.
I had to call favors to everybody and apply every pressure I can, every Jewish guilt that I can enforce on that was there. It was everything. Everything was like, and it's even worse because I would have called Saeed, you have to do it. And then Saeed, he said, fine, I'll do it. You go. And then 2 days later, I said, I hope you didn't close because we had a bug and the quote was off. So it was still in that process. I think the only thing that we haven't developed at that point of time was basically renewal. We said, okay, if there's one thing we have to develop, we have a year to fix the renewal. So we came up with, there wasn't a renewal functionality.
No, because it's very interesting. From the first 100 customer, how many new customers do you get now per month or per day?
Probably around 600 new customers a day.
My God.
So that's the power of scale. Like stuff that we used to do in a month, let's say 6 months from actually selling, we're doing it by 9 a.m. Mm-hmm. It's just the scale is very, very different.
Going back to Ashorian and the cell phone. I work with a company in Germany and in Spain that they are like Best Buy of Spain and Best Buy of Germany, but their biggest product is cell phone, and their biggest profit is selling insurance for a cell phone. So they pretty much sell the phone for cost, but they make their money on the insurance side of it. Is there a lot of money in insurance, Assaf?
So, firstly, we can have a cell phone coverage is a very, very different product. They actually don't make too much money on the insurance. What they make is on the refurbishment and the fix-up, which they can charge whatever money because the insurance is a regulated industry that has to adhere to a certain loss ratio. So profitability is relatively set in insurance. These businesses make money on their labs that charge the right, whatever charge, markup they want, and then they circle it out into the insurance. That's usually how the money is done on that side of the business. And Assurant built an incredible business on that, basically on that stuff. Now, insurance is, it's a tough business. Let's be very honest. Now, different lines in insurance are acting very different. Other than the fact that there's the word insurance attached to it, there's not a lot of correlations in many ways. Like, title insurance has a 5% loss ratio, but auto insurance has a 75% loss ratio. Life insurance is a completely different business. It's an asset management, and you need to do underwriting in a scale of what's going to happen in 28 years, which is very, very different. Each line is very, very different, has a certain risk return as well as loss ratio, but a different scale, a different way of underwriting, a different way of, it's just very, very different. So I don't think anybody can say, listen, insurance is a good business or a bad business. It depends on the fine tune of each specific business line that we're working in.
So if I can like little bit cut, the peels off 600 new policies per day, do you advertise to get those, or do you do it at the time of the purchase of the product? I mean, like if Amazon gets into insurance as they are selling appliances, or Walmart, would that be a competition to you?
We have numerous channels. Direct to consumer is one of them. Then we work with other insurance companies and independent agents to sell Hippo, and that's it's a different technology platform. And then we have a lot of partnership. We have a whole partnership track where people are, when you purchase your home, then if it's the title company is going to offer you, the mortgage company is going to offer you, maybe the realtor is going to offer you, the builder like Lennar and Toll Brothers. So we have a lot of partnership in that side, and then we have a partnership on all of the the IoT device that we're giving 80% of our customers are actually operating, and it can be SimpliSafe, it can be Comcast, it can be Vivint, it can be ADT, all of these guys that are also selling us and we're selling them. So there's a lot of routes on that. Now, if Amazon and Walmart and stuff like that, yeah, listen, but everything is a competitor, but just home insurance itself, it's $100 billion market a year in premiums, grows at $5 billion a year, and going to keep on growing for forever, because there's going to be more homes in the US next year than there are this year, because labor and material have a tendency to go up, because the complexity of our homes become a lot more complex. You have a lot more bathroom per room than every room in your house have an ensuite. And when we grew up, you used to stand in line with your brothers to brush the teeth. So there's a lot of things that actually change in the house, and the size of the home is changing. By the way, there's also more single than couples, which means that there's going to be more homes even on that component. So it's going to keep on growing. I think the largest one is State Farm, who doesn't really want to massively grow because of their risk appetite. And they're probably, I would say, 20-something% of the market. And then it goes down to Allstate, which is probably 10%, and trickles down really, really fast. So nobody has a full kind of market. There's also a risk component. So you don't want to take too much of the market, because you're going to have exposures and diversification of risk and all of that kind of stuff. A lot of the carriers don't want to write in specific areas, or they want to mitigate risk in a different component. So nobody actually, it's not a software game where everybody wants to write 100 and the winner takes 70% and then 15% and goes down. It's just a very different market. Different customers, different touch point, different ways that they actually purchase. With that being said, to your question, what if Amazon and Walmart comes in? Interesting. Listen, but the way that I look at it, we're in the best position to compete, as opposed to Liberty Mutual and then Farmers to compete with Amazon. I'm happy to compete with Amazon, because I'm a lot more wired to this thing. I think the people that are going to be burnt first are actually the people that are not wired this way. We have a captive sales force or independent agent sales force, and they are a lot less wired to move fast.
Wonderful. If the insurance business is changing quite a bit, I think mobile banking, mobile payment sort of became first a few years before insurance. Let's say if you had a crystal ball, how much of insurance do you think is purchased online today versus 2025? Is it similar to e-commerce? And then my question would be, this shelter in place and this COVID-19, has it helped your business or has it hurt it?
Firstly, I think that the whole COVID has sped up online distribution by 2 to 5 years.
That's right.
Businesses that are wired and set up in a certain way are going to see a surge of interest, and it's going to be the base for any business that wants to actually compete in the future. So it moved fast. People that weren't used to buy stuff online were forced to buy, and first Amazon, but once you get used to a digital first kind of experience, you're expecting that from any other provider that you have.
That's right.
So
Yeah.
I think there's going to be, there's definitely a speed up. We have some other implications of COVID. At the beginning, there were less. There was a frequency of events coming from the home, but less severity. Then it went up in severity. Then because our homes are not wired and not set up to have a family of 5 staying with them 24/7, have 15 showers, 3 meals every day. Your door is not set up to have 500 times a day open. It's just so homes start to deteriorate way faster than they were expected to before, which changed some of the losses. On the flip side, people are at home. So if there's a small leak on something, you stop it when it happens. So there's a benefit on that side. All in all, I would say it's kind of a wash, probably slightly negative to the risk of insurance companies in home insurance. So you had that component. But for a digital kind of distribution, I think there's a speed up. Different lines, again, have the average ticket size that we have is around $1,200. And it's usually done in a context of you buying a home. So it's slightly more of a serious. You don't buy a lot of stuff for $1,200 online like that. Especially you want to sit down and read and give it the gravitas for that. So people are buying mobile, but it's an online experience, and I would say more desktop than mobile.
Yes.
And it's usually one of the, for most people, you don't buy home insurance, you buy a home. So you're going to sit down and do the mortgage, and that's a big, it's not an immediate thing. Well, you can do it with Rocket, but I'm doubtful how many people finish a full transaction of a mortgage on their mobile. You want to sit down, you need to upload some documents and all of that kind of stuff for the mortgage, and then you're sitting in front of your desktop and you're getting it. So I think the digital side would increase significantly. The mobile aspect would increase, but I don't see it moving to a full mobile kind of experience.
No, but I meant you're absolutely right. For a $1,200 purchase, especially home insurance, you're sitting on your desktop. I meant more digital rather than mobile.
And I think there's going to be a massive transition. Half of the company, when we started it, started with this hypothesis. The average age of an agent in the US, when we looked at it in 2015, was 58. It's north of 60 now. So it's going in one very clear direction. 87% of agents, of new agents to the profession, are leaving the profession within less than 3 years. So what you have is a profession that nobody actually wants to join, but everybody else is basically maturing out of it. And we thought that the simpler lines in insurance, they have to go direct. We started a company building the Geico of home insurance. And we thought what basically transpired in auto, which is basically direct because Geico and Progressive are the only one who take market share, is going to move to the other lines. The economics on a captive sales force are the worst for all of the insurance companies, hence why some of them that have a captive are shifting them into being basically independent agents. This is what we're seeing with Allstate, with Nationwide, with a lot of these guys. So why not start something with the best economics? So this was our hypothesis back then. Now we just sped it up by several years.
Wonderful. And then the title of our talk is Raising Money During This Time. How did your last round of financing go? Was it similar to your, last year's financing round? Did anything change for you?
Firstly, what you're seeing in the trends of fundraising is that the numbers are slightly decreased in the amount of dollars invested, but a lot more of it is actually going to late stage. So there was a significant de-risking. What you're seeing is mega rounds of companies that are kind of have a product market fit, and they have bigger pockets of money. Also, interest is very low and all of that kind of stuff. So this is what you've seen in big trends. second thing, we did this round via, it was COVID time, and it was all Zoom. We didn't meet a single person. But even that, we went for this funding round in March, which was the heart of COVID. Everybody were in the bunkers. Stock market was down 32%. Everybody were looking for a crazy deal. Nobody were like, the best of them said, listen, we're going to give you a flat round. And we're like, what the hell are you talking about a flat round? The company more than doubled. We were buying an insurance company, which we basically signed a term sheet on. We need the capital for that. We know exactly what we're executing. COVID has not impacted. If anything, it's slightly positive for the company. Why am I getting penalized? And everybody's, the cost of capital is crazy and all of that bullshitness. And then, so, we were able to get the right investors and basically close in a round, which was an up round. If we would have waited probably 2 to 3 months, it would have been a significantly higher because, Lemonade went to the market and Goose said is getting a crazy valuation, and SelectQuote and Kinsale and all of the public companies that have to do around that kind of stuff had a crazy massive bump in valuation. So our comparable would have been very, very different. But with that being said, I think the de-risking that happened, the right investor that we put was completely fine considering the situation that we had. It was not easy. I actually thought we were going to do a debt round at that point of time. There was a lot more abundance of debt than equity when we started. Now it's flipped again to have a ton of equity in the markets. It was definitely an interesting thing. We had to prep more. So we had to have a very, very tight data room with all of the cohort analysis, with all of the, all of the analysis, all of the research, all of the stuff. Every nuance was, we had to up the level of prep on the data room. And it's not easy, it's difficult at best to get an investor to basically write a check and lead. Over Zoom, when you have a discussion like that and you have 5 guys, it has the tendency to go to the lowest denominator.
Negative, yeah, it goes.
It's enough that one guy said, yeah, but I actually look at this and and all of a sudden it's like, okay, now the entire discussion. When I'm in the room, I can control a room a lot better. Mm-hmm. I can see what's going on. Half of the time, people are texting and asking. It's just there's a certain attention span. There's a certain level of conviction. So our best bet was to first go to people that we have a long-lasting relationship with. And we take pride that we always over-deliver to the numbers that we put before. Hence why you get credibility after 5 rounds. You go to people that were, constantly missed out, and there's a higher likelihood of bringing them in.
Excellent. Good. Congratulations. It's been an incredible job. Before I ask George to answer some of the audience questions, I was wondering, Assaf, have you heard about what my colleague Ali Safavi is doing, and what do you think about that?
Hey, everything that Ali is doing is awesome. Let's start with that. The relationship that I started with Plug and Play was because of Ali, and hey, I consider myself to be a personal friend for Ali, as well as a business partner with him, and anything that Ali is doing is a stamp of approval to begin with.
Wonderful. I am the main seed round investor in it, so I hope he does well.
I hope so as well. And if I would bet on someone, it would be on Ali.
Sounds great. George, please, Assaf, it's great catching up with you. I love your openness and frankness and how, direct you are. I mean, you're always was direct, but this is even beyond.
No, I think it's the only way to communicate. I think one of the biggest things especially for a startup, is to really understand where you stand and have a very honest discussion. Otherwise, you can't solve anything. And if you have all kind of layers and you need to discount and you don't have the right data and information, then you can't make the right choices. Being direct is really important in anything in life, but in early stage companies, it's even more important because otherwise you have no idea what you're solving for.
That's great.
Amazing talk. Thank you so much. So we're going to kick it to the audience questions. And just before that, actually, my phone was kind of blowing up because people are really enjoying this talk. This is our 3rd one. And I've literally gotten 6 text messages from our colleagues that they're really enjoying this. So Assaf, thank you for being here.
Oh, it's a pleasure.
So a few audience questions here. First one from Eric. You were talking about raising your first outside capital. How how it was vital for you to not be from the insurance industry. What made you the perfect person to start this business for the lack of experience in insurance?
I don't know if I'm the perfect person to start. It's like, I think we hit on the right problem in the right time, and we executed meticulously. I think a startup, my previous startup, while I sold it, I think it was the right problem, not the wrong, but the wrong time. So, and I don't think, like everything in life, there's not one person who can solve a problem. So I think, it was the right problem, it was the right diagnostic, it was the right analysis, which actually haven't changed. It's the same hypothesis that we had for the seed round, is still what we're doing now, slightly broadened and stuff like that, but it's the same one. I think this business fit me personally. I am not a technical founder, hence what works for me is hard business problems that have hard market and have a component of technical component. That's just like, Airbnb. It's not a technical per se business, and same as I gravitate towards that, and I'm fitting that stuff. I'm a strong business development person, so different people have different kind of like super skills. For me, it's business development. A lot of the distribution that we have is business development distribution, Comcast, Lennar, some of the biggest banks, etc. So it works for me, and the same, and an extension of that, it's not that it works for me, it works. I was very fortunate to have the right team that basically was covering all of the blind spots that I had, and they're doing way better job than what I could have done. Because at the beginning when we started, the first hire that I had was basically my VP of product, and it's usually that one of the founders is the VP of product and the other one is the technical. But in our case, there were two products. There was the insurance product and there was the actual consumer product. And I wasn't from the insurance, so I said, listen, the only thing I need to deal with is the insurance product. I need to understand what it is. I need to, was it beneficial or not beneficial? I have no idea. I have one case that I can basically analyze on, and we made it work. So, it's not a systematic thing of several things. I think the market was frothy in 2015. Nobody talks about that, not in terms of funding, in terms of reinsurers were open for that stuff. They were doing crazy low margins. The market was very soft, and reinsurers, which are the ones that are actually taking the risk on our business initially, were open and receptive for that kind of deal. And I think that's what enabled a lot of the insurtech to start. Right now, the reinsurance market is way tighter and harder, and it becomes a lot harder to get capacity from them because they lost money on weather, on COVID, on a lot of stuff, and they're just not very open to do a lot of these deals. So timing is a crucial component of that.
Totally agree. Totally agree. Probably one of the more important topics that founders and VCs don't talk about is like that timing and hitting it right on the head. Okay, so we have a bunch of questions, so I'm going to try to get through these as much as possible. Apologies in advance if we don't, audience. Question from Jennifer. She has two, so I'll ask the first one. What were your top 1 or 2 lessons you've learned as your career as an entrepreneur? And Saeed, feel free to jump in with an answer as well, being an entrepreneur yourself.
So for me, Hippo is the correction of all of my previous screw-ups. I had all kind of businesses, and each one, when I sit down, there were several components that I didn't want to do. Hardware, I'm like, I swore I'm never going to do hardware again. I don't want to. I hate the cycle. I hate the tooling. I hate the shipment. I hate the inventory. I also hate businesses that are getting one pay. One of the things that I really like about home insurance is once a customer purchases, he's probably going to keep us for like 9 years. And there's a very high likelihood that the reason that he's going to dump us is because he actually sold his house and he's going to buy us again when he's buying the next house. And so you start every time with a very high level or high base of repeated, and I love it. It's like a SaaS product with a basically good unit economics on a consumer market size of $100 billion. and a very low churn. It's a freaking awesome product when you look at it this way. So I wanted to kind of find something like that. I have a $1,200 average ticket size, which has a tendency to increase because you're going to have more stuff in your home and more things next year. The churn is very, very low, and I have a $100 billion market. How many SaaS products can you actually talk about that have that kind of stuff? So this is the correction from all of my previous. Try to find a business that fits the characteristics that you want. That's for Jennifer. I would urge to go to the biggest TAM possible and just address it. I always have a saying that I'm going to work as much on having nicer pens and creating pens or solving world hunger. I have a finite number of hours in the day. I'm going to work my ass on that. Might as well work on something that has the highest impact, the highest outcome, and the biggest TAM, and not work on something small. And I think people have a tendency, because they have a bias to a problem that solves something for them, to work on something which is very, very narrow. And I would urge them to actually take a macro look and solve something bigger.
So if I may jump in, I want to answer for Assaf. 92 out of the first 100 policies he did, I think hustle and hard work trumps everything else. And last fireside chat I had, it was with Nick, the founder of Hill, and he said his whole turning point was asking Google, head of human resources, do you want healthcare for your employees at home? And Google introduced him to Aetna, who said, I want to offer this product to my employees. So I don't know, how do you feel, Assaf? How much does hard work matter compared to the technology or idea or timing? Because
this is something that changed significantly in my mind. So a couple of things. Hustle, I think, is key. And I think Paul Graham has a very, very good piece saying, do stuff that do not scale. At the beginning, as a founder, you need to do whatever to get to a certain scale. And most of the early initiatives are non-scalable. It's definitely not scalable that the CEO of the company is going to keep on knocking door to door to basically sell something. But at the beginning, you need to get momentum. You need to have learnings and stuff like that. The thing about hard work is one of my biggest kind of learning. In my previous companies, I was working 25 hours a day. I believe that if I have X amount of hours, I need to do better. I need to outwork everybody, etc. Now, I actually think working smarter, working better, having better teammates that are still very accountable and doing their, working their ass, but not more, is key. So Hippo is a family-oriented place. I have 2 kids. I want to be an active dad. It's really important for me that almost every day I'm at 6 p.m. at home to have dinner with them. I'm not saying I'm not going to work at 8:30 afterwards to answer emails and stuff like that. But this is something that is key and very important for me. And I want all of my employees to have the same kind of thing. The other side of it is, because it's a family-oriented place, I'm looking at it as a mature place. So if Saeed wants to take a break to go to take care of his kid's soccer game, you should do it. But it's up to you to pick up the slack on the time that you basically left to see. I'm treating you as an adult to take care of your time. And it's not about hours of that. It's about being accountable and pushing the ball forward as much as possible. You're either going to be the right fit or you're not going to be the right fit. And it doesn't mean that you can be very successful in other company. But we need to find the right people for us. And hard work is, smart work is more the right thing that will, and a sense of urgency and speed, which is even more important to me.
That's great.
Amazing, amazing. There's so many questions. I think we might have time for 1 or 2 more. Assaf, here's a question for you. It's not every day that a startup acquires an incumbent. Hippo recently announced the acquisition of Spinnaker Insurance Company, a New Jersey-based national property casualty insurer. Will we see more startups acquiring incumbents? Will we see the consolidation within InsurTech?
Let me give you the logical, I can give you the case, and I cannot answer if we're going to see more or less. The problem is that, here's the situation. We started as an MGA, and I'm talking, these people are all in insurance, so they would understand. I don't need to explain too much. So we started as an MGA. And an MGA, basically, you are listing someone else basically regulatory and capital, you take a frontier. There comes a point where two things basically transpire. Usually, the bigger you become, you're enjoying economies of scale and economies of scope, which basically means that if I'm writing $10 million in premiums, it's fine that I pay X. But if I'm writing $100 million in premium, I expect to pay less. But what happens is that you're actually going to have a tendency to pay more. And the reason is you become a bigger part of their book. They would ask you to take more reinsurance that they can't weather. There's going to be all kind of stuff. So now, instead of you paying the 4 or 5%, which is the standard fronting, you find yourself that in actuality, you actually pay 7%. And that becomes ridiculous. I grew, I became better, and my economics has deteriorated. So that raised a very big strategic discussion in the board. The second thing is a lot of these guys are not very big companies. And what happened is that we outgrew the pace of growth of Hippo outgrew the pace of them be able to actually get capital to sustain our growth. So the biggest bottleneck that we had was that they couldn't grow fast enough to support our growth, and that created a bit of a challenge for us. And the last component is our pace of innovation was significantly faster than the pace of them approving our innovation. So I had another middleman. If I want to change something in the underwriting, if I want to change something, if I want to negotiate something with the reinsurer, I always had a middleman. It's not that material at the beginning because you can't have a balance sheet and you can't, there's a certain fine point of when you're doing it. It's a lot easier to buy something for $100 million when you have $1.5 billion valuation than if you're doing $100 million when you have $50 million valuation. There's a certain trade of when you're willing to do that trade and what's the cost and dilution. Is it going to happen? Probably as there's a scale up of more companies, you're going to start seeing it. Next Insurance is a carrier. Pi did a transaction that enables them to buy a carrier. Root is a carrier. Lemonade is a carrier. There's a certain thing that on a scale up, you cannot have that. MGA is amazing, and this is how you build, and this is how you do everything. There would probably be a case of either acquiring or setting it up. Keen has a reciprocal. We could have gone the route of actually starting a carrier, which would be cheaper in many ways, but then you have seasoning requirement and some timing. And if you think the timing is of the essence and speed is everything that a startup has, sometimes you need to acquire.
Amazing, amazing. We're out of time, unfortunately, and we couldn't get to all the questions, but Assaf and Saeed, thank you all very, very much. Really appreciate it, Assaf, and great to connect with you again.
Thanks for having me.
Assaf. Thank you, George. Great having you, Assaf. Let's get together soon.
Just say when.
Thank you, thank you. And for everybody on the line, if you can stick around for the brief survey, let us know if you like this chat and any feedback for us. These are my details here, George Dimoni. If you have any questions, comments, or want to reach out, my email is george@pnptc.com. Thank you, everybody. Have a great day.